the other kind of big thing is I've talked to you about this, privately, I think, Greg, is that the last 10, 15 years, the S&P 500 has massively outperformed, the rest of the market, international markets, like almost everything else. And I don't know, I had a pretty diversified retirement portfolio, and so I've lagged that quite a bit. But it's got a high PE ratio now, kind of. I think that especially these top 10 stocks or so. And the question is that going to continue? Is that just a new feature of the market that the top international kind of multinational companies will continue to command a higher PE in the future? Is there going to be more? Is there going to be, the next 10 years, 15 years, is there going to be the rest of the market's going to do better against the S&P 500? And that question I don't know the answer to, and I'm not planning to change my current diversified allocations.
Yeah, the interesting thing is the top 10 stocks, that are overpriced right now, like the big tech stocks, they're the most profitable too. So the one thing I'm going to go over today is, what are the mutual funds holding? What have they changed, recently? Because the way I've structured my portfolio is I try to buy and hold stocks that are going to continue to grow, even if they're slow growers or whatever. I look at the mutual funds and say, well, if they're still holding those same stocks, maybe that's the stability that you might need in a portfolio if you want to buy and hold for a long time. But right now they're overvalued. But there's stocks like NVIDIA, I'm going to go over today. It was super overvalued last year, but because their earnings are going up in a major way, they're actually half priced right now. It's amazing. So it's a question that's all revolves around how their earnings are going to be in the future. And so far, they've been reliable growth enough for like a Fidelity or all these mutual funds to continue to hold them in their top 10 of their portfolios. So does that make any sense? Right, so I'm going to go just because, just for review, just the elements of a Roth IRA and a conversion. Let's say if we start off with 100,000 in your Roth, in your 401, the Roth is on the left and the 401k is on the right. If you do a conversion, you're going to have to pay your tax bracket, which is around 24% for a $100,000 a year job. So you would start with less, and then every year, you grow. Eventually, what happens, what I'm doing is I'm keeping track of the age here. You're age 31 now, let's say, and right whenever you turn 72, you start taking mandatory withdrawals if you're a 401k. Now, you're going to have more, let me see, hold on. Okay. So you're going to have because you started with less. Okay. Because you start with less, you're going to have less in the 401k whenever you reach retirement, if you have the same growth rate. So this is the big problem. When if you do your conversion now, you pay your taxes now, but you don't have that money to invest. So okay. So what we're going to do is we're going to look at age 72 again here. You're going to have much more in your 401k because you started with a larger cost basis. You started with 100,000, where this one you started with 72. But what happens is, as soon as you turn 72, you start withdrawing these mandatory withdrawals. So basically, it's 72 to 100. They have a calculated amount that you have to take out for each year, so that in the 401k you end up with zero. And the Roth, you don't have to take any money out. So that's the big difference between the two. And it isn't until, let's say, 6 years into your retirement that you break even, because you're taking money out, but that's whenever you break even and your Roth actually starts outperforming.
But I think the big star there is that money on the left is much more valuable to you than the money on the right, because the money on the right you have to pay taxes on.
Yeah.
So even though they're even, the one is not the same amount of money to you. Right?
Yeah. So this tax is paid. It's all relevant, because whenever you're retired, you probably don't have a job, so your taxes are much less, like maybe a 10% tax bracket, but still, you're paying these taxes. And for a lot of people that I know that are retired, they don't want to be taking out money because they like their stocks or whatever they're invested in, but they're forced to do that. So right around 6 years after you're retired, you have a break even. But the biggest thing is whenever you get older, you have a sizable amount more if you have a Roth, because it grows tax-free. And the best thing is when you take money out, if you take $7 million out when you're 91, it's all tax-free. Whereas if you take money out of your 401k, you got to pay taxes on that. So that's the big issue.
But I mean, Greg, wouldn't to be fully fair with this comparison, though, wouldn't you want to have column F added to column J, where column J is modified by some kind of by an 8% return as well?
Oh, right. Yeah, right. Actually, because you're taking money out, you should actually.
I mean, you can still invest that. It's just you can't put it in a retirement account.
Right. So actually, one calculation should be you take the money out and you put it. Let's say you can put it back in, but that's how much money you have. Yeah, let's say you're right. You actually take money out. It's not apples to apples. You still have you withdraw this amount of money and you have a certain amount left over. So I should have another column here that adds up what's left over after taxes, and then at the end we can add that all together, right? So that's the idea of the Roth.
But it's a fair point that there's a certain amount of money that you are not allowed to have grow tax-free once you start hitting the mandatory withdrawals. That's kind of the difference beyond the variation, the tax rate play, where are you going to pay more taxes now, or are you going to pay more taxes later? Which there's obviously a lot of stuff that goes into that calculation.
Right. So you're forced actually to pay taxes after you're 72. That's the hard part.
I hadn't realized this is actually somewhere that Roth IRAs and Roth 401ks were different until I guess this year, that Roth 401ks did have RMDs according to the IRS, but that's going away. But that's something that can change over time. It looks like there are all sorts of things that they can change, but this is one I did not realize that was actually a difference.
Maybe by the time we're retired, they change the rules where everything's taxable, and then what are we going to do?
But I could see them making RMDs required or something, instead of changing the taxes.
Yeah, that might happen.
I would imagine that there would be a lot of pushback on. Oh, actually, we're going to tax Roth. Sorry, we're going to tax you again on it. Yeah, but that seems far-fetched.
They could do things around the edge, though, like So what? The other thing my big takeaway from this is that I probably want some of both. My current plan has been that I have more Roth and less traditional, but I think there is some advantage to having a balance. And I do plan on taking withdrawals in retirement. But having some options, I think, will be good.
Mm-hmm. So actually, I should have added, if we do the withdraw for the Roth, and it's the same 25%, you don't pay the taxes. That's the only difference. And we can. Yeah. What I'll do next time is I'll just add this up and basically, subtract the amount of taxes paid, and then we'll have a fair. Because if you withdraw without paying taxes versus paying taxes, then you'll have a little bit more a better estimate at the end if you add just only subtract what you paid in taxes. So that's a nice little exercise to go through every now and then. Okay. So any more questions about Roth conversions? All right. So another thing to think about, this starting out with 76 versus 100. If you're happen to be in a tax bracket for whatever reason, where maybe you're in a 10% tax bracket, not 24%. There are times whenever, let's say you didn't work half of a year for some reason, and you end up with a smaller tax bracket. Then it would make sense to convert more up to a certain as the next tax bracket, and that's one way you can, over time, put a little bit more into a Roth, and then not pay it, a whole 24%, of your $100,000 a year tax bracket. And at tax time, I also think about, well, to get into a tax bracket, sometimes putting money into a regular, like your individual retirement account, that could help you manage your tax brackets a little better too. All right. So, is there anything anyone want to talk about in the stock market in general? Anything for me to cover today? Okay. Hear anything? Okay. So what we're going to do is we're going to look at where we are in the calendar. Okay. So what we have right now is we had the banks started earnings last week, and we have about 20% of the S&P reporting the earnings from the fourth quarter. So what I like to look at is, where are we in the stochastics in the S&P? We're overbought. We're at 71. So usually when this is 71 or higher is overbought. And when we're down here at the bottom, like at 0 to 20, that's oversold. So we're overbought right now going down. And you can see this S&P has been in this channel for over a year, and it's super reliable right now. And so that's why, and we're getting into a statistically bad part of the year. February is usually one of the worst months of the year. So being overbought, and we have earnings reports coming out. So I'm expecting it to be kind of sideways or down for the next week or so. And what we have right now in February, we start the earnings for tech. So tech earnings always is a major catalyst or one way or up or down for the stock market. So there's a lot of AI related buzz right now, and a lot of stocks like Nvidia and Microsoft and companies that are doing AI are getting a lot of extra bids on their stock. And all that's going to be coming out probably the first and second week of February. So that's why that's a catalyst for the market to go up. And sometimes you have to go down before you go up. So the other things are we don't have a Fed meeting until middle of March. So there's going to be a lot of ups and downs in the 10-year and the interest rates. Right now, the treasuries have been going up. And you can see we're starting an uptrend in this. That's not good. You can see the inverse correlation is still there. But you can see the higher highs and higher lows. That means we're most likely going to be starting an uptrend in the interest rates. And that's totally not good for stocks. Another thing is we have to think about, there's a lot of smart economists saying that there could be a recession coming up. We have a lot of signals that say we're going to be in a recession. And a lot of times, if you're in a recession, the stock market goes down 10 or 20%. So you got to have the fortitude when you own stocks to sit through a recession, because it's usually like a month or two, and then it goes back to normal in 3 months or so. So February is traditionally like one of the worst months of the year. So if we look at our months, February 0.29%. We don't have any earnings reports coming out in February, and people on the East Coast, they're freezing cold and they don't feel good. There's a lot of reasons why February isn't a good month, but that's why I have it as yellow. So we can make sure we're ready for it to go down. And you know what? The October, November, December was actually right on par. I mean, last year, September, August were bad months. Last year, we had up months in October, November, December. So so far, this has been working out. It's not perfect. If it was, we'd be all millionaires. But let's look at what else is happening here. Okay, so there's supposed to be some interest rate cuts, and they say 2 or 3. So we don't know about that. But right now, the economy is doing pretty good, and that might not happen until like later on in the year. And that's the big thing that in Yahoo Finance, they say, what's the big unknown, biggest immediate risk to the stock market? And that is interest rates. And so that's why we keep track of that every week. We see Federal Reserve. So interest rates are the most important factor right now in whether the stock market goes up or down. But for my portfolio, whenever I'm investing, I like to buy and hold. And what I'm going to do today is I'm going to go through some, let's see, let me show you what I'm showing. Okay, what I'm going to do is I'm going to show you some mutual funds and their holdings. And a lot of these mutual funds, they haven't changed their holdings in like 10 years. And a lot of times whenever you see the same stocks being held by the same mutual funds, it's a very good indication that these are stocks you can buy and hold for a long time. And whenever they do change their positioning, you got to look at why and should you actually change some of your positions. So I'm going to review this real quick. Contrafund is one of the most successful funds by Fidelity and one of the largest in the world. And I looked at some of their holdings from last year at this time, and I compared it to this year at the end of last year. And I noticed that their Meta holdings have increased, almost doubled. It went up a lot, and they didn't sell any. So that's a very good indication that they still have a very high opinion of Meta. And they increased their Berkshire Hathaway position, and their Apple position was nothing before, and now they have a 4.4 position. So whenever the green markings are the ones that are increased, the ones that are yellow, they decreased. So looking at this gives me conviction when I'm managing my own portfolio to continue to hold these stocks. And whenever you look at all the mutual funds that I usually do once every quarter, you see that if the big mutual funds continue to hold these quality stocks that are quality compounders, they call them, is a very good indication that you can still hold them in your portfolio, and even if it's a recession, even if the stock market's going down. So what I noticed is both of these are starting to buy Eli Lilly, and we've been following that for like a year now, actually, and it's turning into like a growth stock. It's growing at like 30%. And they have an Alzheimer's drug and a weight loss drug that they're currently excited about. And NVIDIA is a new holding for Contrafund, and it's a new holding for T. Rowe Price Blue Chip Growth. So what I did was when I have a portfolio, I like to model it after these mutual funds. And on top of that, if any of these dropped in a major way, I would look to buy that stock or whenever it's down. So we're going to continue to follow these, and if we ever see any of these stocks pull back in a major way, we're going to start looking to see if it has any credence. Let me see. So they got rid of PayPal. That's interesting. This is one of the worst performing stocks in the stock market in the last year or two. Let me see. Okay, so what I'm going to do is, next thing we're going to do, we're going to look at our bullet points. The U.S. Treasuries are actually up 2 to 4% this week, and that's why the stock market is a little bit iffy. It's going down recently. The stock market is losing momentum too. So all the uptrends we've had for over a year now, it's starting to cool off. And let me see. and we're having like a return to the mean. It's the market breadth is kind of spreading out from the big tech stocks. What else is happening here? We're still at a good seasonally time of the year. January is a good time of the year, and it's pretty much unknown what the interest rates are going to be, because there's a lot of people coming out this week saying that the interest rates aren't going to happen until the end of the year. So what happens is, if this interest rate cuts is pushed off until, they're saying until September, then the market will like super go down, because they're expecting 6 interest rates cuts this year. And if that doesn't happen, that's like the biggest thing that could weigh on the stock market, and that could make it go down 10 or 20%. All right, so that's the big picture. Let's look at, we know the S&P is overbought right now, so that's why we think it's going to go down in the next week or so. And this, the 10-year Treasury is, you see, the 10-year Treasury is going up in an uptrend. So if this continues to go up, and that means the stock market most likely will go down. So you got to be ready for that. And right now, the oil is still low. That means that maybe a global recession is coming, or we're just producing too much around the world. Inflation is actually going up. So it's been creeping up recently. So it's, it's going down this week, down 4%. But the US dollar is going up. That's not that good. And right now we're getting more fearful in the stock market. So we were extreme greed, now we're greed. And when it gets time to be fearful or extreme fear, that's the time to start buying or looking to buy things. And we're still bullish in the AAII sentiment. So these are all contrary indicators. This is not the time to buy, because everyone is excited and still bullish. And the time to buy, let's say last time it was bearish was November of last year. That was the absolute best time to buy. So it went up 20% after that. So we have to wait for this to be bearish 50% to know we're gonna. It's a good time to buy. Right now, the dollar is still in a downtrend, but if this starts, this is almost the same as the U.S. Treasury. If this breaks out of here and starts going in an uptrend, that's not so good, because the U.S. dollar is, if it goes down, it's good for stocks. If it goes up, it's not good for stocks. And the VIX, people aren't scared anymore. They're still, when it's trading below 12 or 13, that's around, people are complacent, and that allows stocks to rally. And people are still excited in the stock market. We haven't been in a denial or a capitulation for like a year or so. So right now, it's not the time to buy whenever everyone else is excited to buy things. None of these issues are seemingly coming to roost, so these could cause like a crash or 10% or 20% correction. The only interesting thing that could cause the stock market to have inflation or inflation fears is this Red Sea shipping attacks, because it's going to cost more to ship things, that'll cost more to make things, and the prices will go up if we can't ship our stuff through this Red Sea. So the price of oil will go up maybe, and the price of all of our goods, because we can't get it through this Red Sea area. That could cause inflation to go up. But it's not a major problem yet. So the PE ratio of the S&P 500 has gone up 2% in the last month. So that is not that great. We're actually paying up more for the same stock. And right now, the last time the yields were where we're at right now, the PE was 15. So if you divide 15 by 20, that 21, that's how much it could correct, if we go back to a mean. I'm keeping track of the worst at first. And right now, the tech index is is coming back. But you can see the problem right now is we have the rates going up. If we look at you see this U.S. Treasury, and it's going up. As it goes up, and as rate cuts possibly won't happen, all the utilities will not do good either. So these utilities are totally dependent on, I think, depending on the Treasury rate. So they're not doing too good this year, so far, year to date. Consumer staples are doing good. Healthcare is doing good. So these two are following ideas that the worst from last year are doing good this year. And information technology and communication services are doing good. So we don't have it worst to first yet, but so far it looks like IT and communication services. These are part of most mutual funds, top holdings. These are doing good. So that's why I'm continuing to hold all my tech stocks, because they're going to go up around 10% a year, over time. So our this year's theme, number one, it's worst maybe first, and interest rate cuts may not happen. If that doesn't happen, and the economy doesn't slow, then we're going to have a major pullback in the stock market. But we have an AI revolution, and that will juice all the AI stocks. So we're following a couple AI stocks like NVIDIA and Microsoft and Facebook or Meta. So I think that's another theme I added to the end of this. But investors still are reaching for yield. That's kind of coming to pass. We have healthcare, they have good yields, and consumer staples, they have good yields. And financials are also doing good this year too. So let's watch these themes as we invest this year. Let's look at some of the ETFs. The sectors doing good and bad this year. S&P Telecom. Okay, so the first thing we look at is the 2-year and a 10-year. The 10-year is going up. If this is going up, the demand for utilities and telecom goes down. That's probably why in the sectors, utilities, telecom. So that's all because of the 10-year. And the ones that are going up the most, semiconductors and tech. So it's amazing how that's a 1-to-1 correlation almost. If this goes up, then the utilities go down, and the anything high yield goes down. But right now, there's a lot of excitement around NVIDIA, and there's like companies upgrading NVIDIA, and all the semiconductors go up with that. So okay, let's look at what other things we're going to look at. We're going to look at the S&P. You can see it's kind of extended here. Let's look at the market movers for stocks. We expect, with the interest rates going up today, we expect the high-yielding things to go down and tech stocks to go up. Let's see. We have airlines. Airlines going down the most. I don't know why. All these airlines. The airlines are at the mercy of the price of oil. So let's look at the price of oil today. Maybe that's because the biggest input cost for airlines is oil. So if you see a big price change in oil, that is why the airlines go up. Let's see. Okay, oil. Oh no, it's down today. So that isn't why they're up. They were down. Okay. But in general, airlines are not that profitable. They usually have a PE of like 6 because they don't really grow that much. And I guess they're making a lot of money on these charges, like the baggage charges and things like that. But it's just an industry that's it's at the mercy of the price of oil and the weather too, I guess. Let's look at the here's the worst at first. PayPal. They were down 80% in the last 2 years. And now they're actually could be one of the best performing stocks this year. We'll see. Broadcom, Qualcomm, a lot of chip stocks. So I guess yesterday, NVIDIA was upgraded. So all these AI-related stocks that are semiconductor stocks are going up, and all the suppliers, the chips like KLA, Tencor. So let's look at the NASDAQ. What's going up the most? Okay, NVIDIA is going up again. So this NVIDIA has gone up like 15% this year so far. And it's like on a tear. We're going to go over NVIDIA a little bit later on. What else is happening here? Okay, let's go over NVIDIA just because we saw it. Okay, so we're going to look at NVIDIA. What I did was I looked at the earnings estimates for NVIDIA, and from last year to this year, they were tripled their estimates, which is pretty amazing. And now their growth rate is around 60%. Their forward PE is 29. If they're growing at 60%, they're half the price they should be if they continue to grow at 60%. We don't know what the demand is in the future. They say in the next 2 years it's 15 and 9%. That's not so great, but they keep upgrading the stock, and these estimates keep changing. So right now it's like half off, even though it's been up 300% since last year at this time. The other statistics, even Yahoo Finance agrees that it's half off. The PEG ratio is 0.5. That means it's trading for half its growth rate. And I looked at Morningstar. They said the fair value is 480, so it's around 14% overvalued. And I looked at the CFRA for NVIDIA, and they say the fair value it's undervalued by 7%. So right now it's actually fairly valued, even though it went up 300% since last year in valuation. I looked at the earnings, and I expected a straight line up, but they're not a straight line up. But they're still growing, and their revenue is growing in a straight line, and the return on equity is it was 44 last year and it's 17 now. I'm not sure why that is, but we like to see each one of these in a straight line up. So it's not that consistent, but still, I guess they're figuring out these numbers, so it might not be accurate. But they think there's an unprecedented. This is CFRA. They say there's an unprecedented demand driving changes to cloud infrastructure and spend. One thing I noted on this is that some of their biggest customers are Meta, Microsoft, Google, Amazon. These are multi-billion-dollar contracts they have to make these. So what's happening is the big tech companies with the big money, they're actually buying this, and that's how NVIDIA is actually making their money with selling to these data centers. And Facebook said that they're going to be buying more, and each one of these companies is competing to buy more. And so that's, for me, looking at a stock to invest, having some of your biggest customers with the biggest pocketbooks with the most amount of cash is like really good. And this is the premium, they have the premium AI product, this H100 GPU. So anyways, I thought that was interesting, and that's probably one of the reasons why it's continuing to go up. It's up like 15% now this year. And AMD is one of their competitors in this, and they're going up with them almost in lockstep. So that's kind of the most exciting themes of this year is AI and how that's going to change everything. So that's why I'm keeping my Microsoft position. I have some NVIDIA, and Facebook is going to benefit from AI, and so is I think that's it for the stocks. Google is actually buying that too. All right, so the ones going down the most. Let's look at the ones going down the most. Okay, so these are all stocks that are paying a dividend. A lot of them. You have Exelon. They're a energy company paying a dividend, PepsiCo dividend company. Tesla is going down. Fortinet. So this is, I think they're a antivirus company. I'm not sure. Okay, so that was a good exercise. And let's look at the Dow stocks. Okay. All right, I don't see any good themes there. All right, so now let's look at some of our talking points. Okay, let's look at, there's an upgrade in Apple by Merrill Lynch or Bank of America. And what's interesting is Apple was downgraded, like at the beginning of the year, by several companies. So that made the stock go down to a point. Let's look at the stochastics on Apple. It's interesting. We were noting last week. Look at Apple. Here it is. We noticed last week that they were super oversold right there near the bottom of their channel, and they're starting to go up right now with this upgrade. They were up 3 or 4% yesterday, but what Jim Cramer says is this Apple upgrade is against the grain. So we had 3 downgrades, and now we had an upgrade, and that's pretty important because when you have an against the grain upgrade, that is stronger than all these other downgrades. So let me see. So Jim Cramer has these. He mentioned these things that are good for. I mean, this is the Bank of America notes on Apple. I follow Apple because it's like my biggest position, and I have to really get on top of it. And Jim Cramer says there's the Bank of America said that there's a multi-year iPhone cycle driven by hardware-enabled generative AI. So generative AI is going to be used on all future iPhones, and that could make people upgrade to the new iPhone. And there's higher growth in services. When there's AI, your Siri is going to tell you to buy things and stuff. So there's going to be growth in services. And Silicon roadmap to more from PC servers to autonomous driving, and that's higher margins. So strong capital returns, including dividends and buybacks. Okay, so these are all the gross margins are higher. So when this note came out yesterday, that kind of gave Apple a kick in the pants, and the whole tech sector started going up. So that could make the stock of Apple stop going down, which it was like the worst performing big tech stock this year, to start going up again. And then we have earnings at the end of this month for Apple, so that could be another catalyst for them. But the biggest problem for Apple is they're not growing. Their growth rate is like 2% or 0%, but their multiple is going up. That means the stock isn't growing, but their PE ratio keeps going up, which isn't sustainable. Okay, so Jim Cramer, there's a note on his show. There's some tailwinds helping the stocks to go up now. And one is this upgrade of Apple yesterday. Japan is actually starting to buy U.S. stocks, and they just started buying this year, and that could cause stocks to go up, and maybe Japan's going to buy another stock. Proxy battles. There's like Disney has some people that are on the board that are trying to make changes, and whenever you have these proxy battles, that could make the stock go up in value because they make changes that make the stock perform better. And the other thing is Apple is starting to lay off, Alphabet's starting to lay off people, and last year Facebook did that, and they started this year of efficiency, and that made the stock go up 200%. And Alphabet's doing the same kind of things this year. So that's what Cramer said could cause the stock market to go up. I'm going to keep track of these Dan Niles picks from the beginning of the year, and he noted that his KWeb pick is like one of the worst ideas ever, because people are not interested in Chinese stocks anymore. We were talking about Chinese. This KWEB is the Chinese ETF for tech stocks, and we noted last year that Alibaba was uninvestable because China was making all these rules that didn't make any sense, and you couldn't predict what's going to happen next in China and what they're going to do to the stock. And so now the China stocks are actually going down like 10 or 20% this year. They're in like a crash mode, and KWEB is going down with it. So we're going to still follow Alibaba and a lot of the other stocks from China, but it's really hard to invest because we don't know the rules that we have to follow in China. The XBI is down 3%. This is the biotech ETF. And one thing he noted about the biotech ETF is AI is going to help a lot of these biotech companies discover newer drugs sooner. And that could be like, why this goes up. But he said this XBI has been down multiple years in a row, and it could be time for it to revert to the mean. Texas Instruments, I think today it's going up with the semiconductors. So this might be something that works towards the end of the year. Meta is up 6% this year. So that's one of his best picks from last year that's continuing to do good. And Amazon is only up 1%. So we're going to keep track of that. And I always like to look at opposite sides of things, and economists that say that the stock market will drop, because you got to be ready for that. If you're long on your stocks, you're invested for the long term. And like I was saying earlier about possibility of a recession, if that happens, then stocks usually go down 10% or 20%. And this guy's predicting that the stocks will drop, a recession will hit, and inflation will start to sink below 2%. And so usually if the inflation sinks, that's usually an indication that the economy is not doing that great. And he says right now we're trading at lofty valuations, which is true. And shrinking U.S. money supply will choke economic growth. So what I did was I translated his article into something we can use. And stocks with high PE ratios, high PEG ratios will go down. So that means when we look at our top 10 in the stocks, we're going to, where are we? It's like there's market movers. We're going to see the top decliners, the high PE ratios, the stocks that are don't have a whole lot of earnings, that borrow a lot of money. The other things that happen, conservative stocks that are paying dividends will do good. So when we're looking at the stocks that did bad last year, these might actually do good towards the end of the year if there is a recession. So let me see, that's other translations from this article. So the stock market might go down 10 or 20% if there is a recession, and that we don't even know that. And okay, he said shrinking corporate profits in a recession, and but the thing is, he said the same thing last year. At the beginning of the last year, he said we're going to be in a recession. So, but it didn't happen. So, a broken clock is right twice a day. So, there's a lot of people that say they give these warnings, but they never happen. For me, a recession is you got to sit through it, but there's one recession for every 5 years. So maybe 1 year out of 5, you have 20% correction. But as a long-term investor, you have to be used to that. Okay, we already talked about NVIDIA. You see. And we talked about the mutual funds changing. What I'm going to do right now is I'm going to look at this is a screen from Fidelity. What I do when I do a screen is I search for all the quality things that we're looking for. And let's look at the return on equity, profit margin, market cap, forward PE, growth rate. We want all these things, and I do my searches every week. And occasionally you get a new stock in there. But what I do is when I look at these screens, I sort by market cap because the larger market caps are a little bit more reliable, and they're in most of the mutual funds, and they're followed more. And I like to look at, some big numbers. Like for a return on equity, I like to see bigger the better. So MasterCard has a 186 return on equity. This ASML, they're like a semiconductor company. They have 75%. And so I highlight some of the interesting ones. The PEG ratio of Meta is 0.93. That means it is 7% undervalued. So this is an example of a stock, Meta, that's Dan Now's one of his favorite picks, number one, and then we know it's growing around 15% a year, and it's held by a lot of the mutual funds. So this is a good indication, that this stock is a good buy and hold stock, and all these numbers, across the line, return on equity is 22, cash flow rate, it all meets these criteria. So that's a good example of why I have confidence in holding Meta. And Google continues to have, all these over 13% numbers for all those, so that's great. You see, T-Mobile has actually gone up 10% this year. They had really good earnings numbers for their subscriber growth. They came out this week, and it says, according to this screen, it's 1/3 of what it should be. And its forward long-term growth is 67%. So I also kept in this Alibaba. This is interesting. This is like a super contrary trade. Alibaba is, let me see, PE is 7, and all the stocks in China are selling off right now. And I still think it's uninvestable, but it's very interesting to see how much more of a premium that U.S. stocks have versus the rest of the world. And Matthew was saying something about this at the beginning, that the U.S. stocks hold a premium because I think we have a fair, and our SEC is a little more stringent than the rest of the world, and people know that there's a higher quality in America for stocks, and maybe the whole regulations of stocks. So I guess we have a premium right now. This China stocks are being sold off. This is another China stock, PDD. And other things, let me see, this PDD has a 134% growth rate. That's amazing. But right now, it's really hard to invest in these China stocks. I thought that was interesting to go through that little exercise. Hold on for a second. Okay, so let's look at some more things that are going on in the stock market. Okay, so the sectors. Okay, I think the ups and downs for these sectors are all due to the interest rates. Let's look at the Yahoo Finance main page. Okay, so this is interesting. This is the longest we've gone in the stock market without a record close. So in other words, if we look at the S&P and look at it going back, we haven't been at this level since 2021. So let me see. It's like 2 years without hitting an all-time high. So that's amazing. We haven't gone anywhere basically in 2 years since the end of 2021. But right now we're actually probably going to close above that. I'm not sure exactly what that means. That could, a lot of times you have prior resistance. This is called prior resistance. Whenever you have it go up to here and it doesn't break out of that, that's called resistance. And right now we're basically at where we were in 2021. So this could be like a ceiling where we bounce and go back down, or if we break out of it, then that's a huge thing for the stock market. But a lot of times this is like a ceiling almost. Whenever we're down here, and if stocks go down to this level, that's like support. So there's a certain amount of support at each of these times that you correct and you hold. And when you go to the top, that's a ceiling. So let's hope we can break out of this. Right now, we're overbought, so it's going to be kind of hard to do that, but that's what this means there. Let's see what else is happening here. Oh, here's a good article. Amazon robot deal may get blocked by EU regulators. So this iRobot company, it went down 30% after this takeout. Amazon was going to buy the maker of all these automatic cleaners of your house, you know, those little robots that clean your carpet. And I guess the lesson learned here is if you have a stock that you and it's a takeout candidate, and there's a chance that it might not pass some regulations, it probably is a good idea to sell it. And because if it doesn't go through, if there's like a block, then the stock goes down 30%. And that's what the advice that Jim Cramer gives. Let me see. Okay. Yeah, that was a good lesson there. Let's look at some of the stochastics that we're following, just for the ETFs. Okay, so I update this every week. So we're overbought in the S&P at the top of the range. That's not a good time to buy. Same thing with the QQQ. We're at the top, and we want to buy when it's at the bottom, right here, when it's at the bottom of the range, and when it's oversold. Defense sector, no, the defense stocks, they're oversold, but they're going down. Gold, it's kind of going sideways. There's nothing going on there. XLY it's oversold, and it's halfway between overbought. I mean, it's channels here. This is an example of XLV. They're totally oversold. Look at that, at 11. But they're like in the trading range right here. So that's halfway between this range and that range. So it's not really a place to buy it. XLC, these are communication services. Actually, Facebook and Google and a lot of the big tech stocks are in this. And this is like rallying. So it's overbought, so it's not a good time to buy that. Let's see. Some interesting. Okay. XLF, this is a finance sector. They are overbought going down, and they're not, so I got another 5 days before they start going up again. Let's look at XLU. This is interesting. With the interest rates right now, interest rates are starting to go up. This is a one-to-one correlation to interest rates going up. So they're oversold, and I guess the time to buy that is tricky. It's tricky because if the interest rates continue to go up, they're going to go down. XLRE, interest rates going up. This one will go down with that because real estate, as mortgage rates go down, demand for houses go up. But if the interest rates go up, demand for real estate goes down. XLE, you can see the price of oil has been down, and I think this goes down with the price of oil. If we're in a recession, the price of oil goes down to like $60 or $50 a barrel, and then these are not as profitable a company. So that's why this will continue to go down until we're out of the recessionary times. But it is oversold. Look at that. It's oversold, and it's near the bottom of the channel. So maybe that is an indication it's still in a downtrend, and that's not so good. EWZ, this is a Brazil ETF. It's yielding around 9%, and it's oversold and halfway between our channels. Uranium, this is one of the best performing ETFs this year, actually. It's up like 8% or so. It's overbought, and it's a copper channel, not a good time to buy. All right, so let me see. AbbVie, this is interesting. The drug stocks are starting to outperform. They were stuck in this range for a long time, and you can see they're making higher highs and higher lows. So that's a very good indication that drugs are going to be doing good this year. And it pays 4% dividend. AbbVie, it's the same chart. All the drug stocks are starting to make this uptrend. So these could be the new leaders this year. And this is like the opposite of, let's look at this one. Okay, worst to first. Healthcare, energy, and healthcare, up 2% this year. So that makes sense that these drug stocks are going to start doing good. Alibaba, this is like in never ending going down. And we lost interest in this last year at this time, but we're still following it because it's interesting to see that people don't pay up for stocks that are overseas now. Google, they're starting the cost cutting this week. They started laying off like 10% of their company. And they're putting more resources into AI. So that could, very, very similar to Facebook last year, that could kick them in the pants and make them go up in price. And people pay a higher valuation if they have cost cutting in mind. Philip Morris, and this is Ultra, they're in a downtrend. Look at that. And looks like the next stop is for them is the here and here and here. That's not so good. But they're paying at 9% yield. Amazon, this is Dan Now's top 5 pick, and it's going up, and it's in an uptrend. It's overbought, so not a good time to buy. The time to buy it was when it's down here. Let's look. Right here. It's oversold, and it's at the bottom of the trend. So that will be the time to buy that one. So we have to wait for that. Apple, it was oversold last week and near the bottom of the channel. Now it's starting to go up again. So earnings are going to either make Apple go up to here or down to here when they come up February 1st. And AT&T, they're oversold, and they're near halfway between overbought and oversold. All right, so that, I know you're probably sick of doing this, but it's good to do it every now and then. Let me see what else. What other interesting ones are here? Okay, we're super overbought in a lot of these stocks, like this one. All right. Okay, this is interesting. MasterCard is at the top of its range. It's super overbought, but this is that means people are excited about it. You know, people are buying it, and it's over. Whenever a stock remains overbought for a period of time, like 2 months, that's a very good indication that there's momentum around it. So, it's not a good time to buy it right now because it's overbought. But let's say the good time to buy it was when it was right here. It was oversold. It was at the bottom of its channel. Here's another time right here. It's oversold and the bottom of its channel. eBay, I've lost interest in this one because its earnings aren't that great. It's oversold, but it's in a downtrend. So I don't know. We'll stop following this pretty soon. This is interesting. The Boeing is actually in a downtrend right now. Their quality control is out of control, and their jets, they can't make them with a quality mindset. So people are losing confidence in the stock, and that's why I've stopped following it. But we're going to keep watching it to see if they have a duopoly in making jets, but they can't produce airplanes that are quality. I think that's it. Thank you very much for attending, and I hope you have a good week.
Thank you, Greg.
Right. See you next time.
Thank you. Thank you.